Welcome to A Canadian Investing in the U.S., a podcast and YouTube channel focused on Canadians buying real estate with host Glen Sutherland.
Welcome to a new episode of A Canadian Investing in the U.S. This week, my guest is John De Goey. John, do you want to start off by just giving everybody like a bit of an intro, a little bit of what you do?
Thanks for having me, Glenn. I'm a portfolio manager in Toronto. I've been in the business for over 30 years, and I do a lot to help people get a better relationship with their advisor. So I've written 3 books, the most recent of which is the one over my shoulder there called Bullshift: How Optimism Bias Threatens Your Finances. And I have a podcast of my own called Make Better Wealth Decisions. So a lot of what I would see as my mission is to help people just overcome biases and think about how they go about investing, and to do so in a purposeful and productive manner.
That's awesome. Yeah. No. Without going in too much into it, but beforehand, when we were talking, we were talking briefly just about how a lot of people, they're their own worst enemy when it comes to doing anything. I even myself personally have done some phone calls recently with people, and people have excuses. I don't know. What are you seeing for psychological barriers that people are putting themselves into?
So I prepared 5 for our conversation today. Before I jump into the 5, I think let's just start at the high level and come down. There's a lot of research with regard to behavioral finance that has come to the fore in the past, let's say, generation. Up until 20 or 30 years ago, finance was about charts and graphs and ISLM analysis and supply and demand and ups and downs. And it was very mechanical and mathematical and theoretical. What people have come to realize is that economics, as well as investing, are social sciences, and that a lot of what you experience depends on how you make decisions. And a lot of how you make decisions is based on the way we're programmed as humans, because we have biases that go back to caveman times that can explain decision making, but we're not as rational as we want to be, and as we claim to be. And so even though there are things that ought to work in theory, they don't always work in practice because human emotion and human behavior gets in the way. So that's what I talk about.
Oh, I totally agree. I think we're all our own worst enemies. Yeah. So maybe let's just jump right into this. So what are you seeing as your 5 or the barriers?
So I'll go through them. What I've done is I've come up with 5. And what I'll do is maybe I'll explain one at a time, and I'll say this is what it is, and this is what you might want to do about it, and then we can yak about any personal insights that you have. So the first one, I always have to start with this because that's what the book Bullshift is about, is optimism bias. And I really have to be very clear about this one. It's not that I'm not an optimist. I'm an optimist. I think most people, if you give financial advice, are optimists in general in terms of their predisposition, their worldview. But optimism bias is a precise thing that has a very distinct meaning. Optimism bias is when you recognize that bad things happen, but you nonetheless believe they are not going to happen to you personally. So here's an example. Most people know that the divorce rate in the Western world, in Canada, the US, and into Europe, is somewhere in the neighborhood of 40 or 50%, depending on what jurisdiction you live in. So most people know that the odds are almost 50-50 that if you get married, you're going to end up in a divorce down the road. If you ask newlyweds on their wedding day, will you be part of that 40 or 50% that's going to get divorced? You will get 100% saying, well, no. Well, I'm not going to get divorced. So they know the stats. They know that 40 or 50% of the population will be divorced, but they nonetheless believe that those stats don't apply to them. They're special. Those divorces are for other people. They're not for me. And all I'm saying is, no, you're human. You understand the risks. You're not special. You're statistically, there's no way to determine in advance who's more or less susceptible to have their marriage end early. So that's optimism bias. So that's the problem. And in terms of what you can do about it is you should look at statistics before you make decisions to understand what the odds are. You should understand going in that 40 to 50% of all marriages end in divorce. But do your part. Be careful and self-assess and think about, okay, well, is there anything about me and my spouse that makes us more or less likely to divorce compared to the general population. And most people will, if they're honest with themselves, will say, no, there's nothing special. Well, we're in love, but you know what? So are all the other couples that are getting married. So these are the odds. So you need to know the odds going in. So that would be example number one, optimism bias.
Oh, love that. Can you imagine going and actually asking people on their wedding day that? Are you looking to invest in the US? Are you looking for a coaching program that will actually save you money and help you avoid mistakes? My students get discounts on lawyers, attorneys. If you're looking to get an E2 visa, if you're looking for certain software, if you're looking to even speak with CPAs, I have discounts for all these things. If you want to just get on a quick phone call and we can discuss if it's a fit for you, 10-minute phone call, go to glensutherland.com or at CanadianInvestingInTheUSA.com and book a call. Yeah.
Yeah, well, it's one of those things where, people have biases and they don't want to acknowledge them. So anyway, that's number one. If we can go on, then I'll just go to number two. Number two is overconfidence. Number two is overconfidence. So a lot of people just think they're better than they really are. If you do a study, you will find that about 80% of people think they're above average drivers. But statistically, we all know that only about half the population can be above average. So people are overconfident with regard to their own ability, and that has implications for their investing, especially men. Men tend to be more overconfident than women. Women, to their credit, I think, are a little more self-aware, a little more subdued. And my recommendation as to how to deal with it is to try to be more humble. There are lots of people who, it's easier said than done, but humility it's very difficult to actually instill humility in people. But if you can at least stop, reflect, am I being a bit full of myself here? Or do I really know my way around this? Because a lot of people think they know more than they really do. And a little knowledge can be a dangerous thing. Oftentimes, there's actually research that shows that if you know a little bit and you think you know more than you do, and then as you learn more, you not only become a little more humble because you're learning, and learning is difficult, but also you become aware of how much you don't know, and you actually become more humble as you learn more because you realize that you didn't know what you didn't know. So that would be an important lesson in investing. If you traded options, you listen to a 15-minute YouTube video about trading options, and now you think you're an options trader. No, you better do a little more research before you start doing something that's that aggressive or that potentially risky. So that's number two.
Yeah, so I see the same thing even with my business, and a lot of the times that people your same thing. It's always males, and they go and like for me, I do it. It's investing in the U.S., and so they go down there and they think they can. I bought one rental property in Canada or done something in Canada, and I can just do the exact same thing in the U.S. And I get the calls, and it's probably not as many as it used to be. I think just the training people with the podcast has helped a lot, but I still once a month I get someone who has made some major mistakes and then they come to try and get it fixed afterwards. And I'm just like, if we would have talked before you started, you could have skipped this tax situation or whatever you've got yourself stuck in. The bad contractor, the bad property manager, just a bad investment, bad deal analysis, bad. You just pick the wrong one sometimes. But anyway, not to go on a side tangent completely, but no, it's the same
Covey,
thing.
I don't know if you know who Stephen Covey is. He's a guy from Brigham Young who wrote a book called The 7 Habits of Highly Effective People. And one of the things that Covey talks about is the carpenter's rule, which is measure twice, cut once. And a lot of people would be well advised to do a little more homework and to double check their work before they buy that rental property or before they buy that cryptocurrency or whatever it is they're going to do. I'm not saying you have to overanalyze, but I think many people would do well to spend a little more time doing a little more due diligence and making a more informed decision before they jump in with both feet.
Oh, honestly, anyway. I think that just I don't trust myself. So ideally you want to put yourself your investment planner, you talk to someone else who knows this. Even whenever I go to buy stuff, I'm going to run it by appropriate people to make sure that these comps are correct for rent. These comps are correct for the purchase price, the after repair value. I can use all these apps in the world, but they're only apps and they're full of mistakes.
Right.
Trust yourself, but verify yourself. Even get somebody on your team that knows this stuff, does it for professionally.
Okay, so that brings me to number 3, which is exactly where I was going. So the third risk is something called confirmation bias. Confirmation bias is something that pretty much everyone is susceptible to, and that's where you look for literally the first piece of information that will support your pre-existing idea. So
Wow.
this happens in politics, it happens in economics, it happens in whatever it is you go in life. There are multiple applications. You say you're doing your due diligence, but you literally, when you Google something because you don't know, you say you want to learn, you want to do your research, and then you Google it, you will literally click on the first story or item that supports the view that you had before you did the research. So you're not actually independently trying to get to the truth. You're trying to validate a pre-existing position so that you can feel good about having done your due diligence. So that's called confirmation bias. So what I would say as a way to fix it, number 1, be inquisitive, actively look for countervailing stories. Instead of just finding evidence to support what you think, humor me. What if I'm wrong? What are the arguments that are being made on the other side of this decision, of this option, so that you can understand what your options are? And your point is exactly right, Glenn. Get a decision buddy. Find someone, a spouse, a business associate, a sibling that you trust, that knows you, who will say, actually, Glenn, that's not a very good idea. And here's why. And then you need to, of course, be able to say, okay, well, if you say so, maybe I was getting a little bit ahead of myself. But that's what you need to do. You need to actually be contemplative about the decisions you're making before you make them. And you're going into the decision-making process thinking, I want to do what's right, not what I can. I always wanted that boat, so I'm going to find a way to justify buying the boat, even though a lot of people would say, you can't afford that boat. You've got these other priorities. You've got this mortgage. You got to put money away for your kids' education. You can't afford the boat. But if you really want the boat, you're going to find some way to justify buying that boat.
Yeah, I think you got to be very careful who you get to be those people too, because those people can talk you out of everything or talk you into everything. So you have to be careful, like who you're taking your advice from and who you're going to support whatever you're trying to do. Are you looking to buy property in the United States, but not interested to travel there just to sign the notary? Did you know there are 6 different ways to sign notary as a Canadian, and only 2 of them involve going to the United States? To get my free guide on notary, go to acanadianinvestingintheusa.com/notary.
Yeah, absolutely. Okay, let's move on to number 4. Number 4 is recency bias. Recency bias is where you make decisions based on what you've experienced more recently. So there are a lot of people who think, oh, I can invest in whatever these growth stocks because, we had a problem with COVID and the stock market dropped by 33% in 5 weeks. But guess what happened? When that started happening, central banks all lowered interest rates to 0 all around the world, and governments started sending out people checks. Hey, I'm bulletproof. I can get through a market downturn because if it gets really bad, someone will intervene and prevent it from getting even worse. And if that's your most recent recollection of what happens when markets go south, then you might convince yourself that if it happens again, I'm going to skate through it again because look what happened last time. That's not necessarily the case. Past is not prologue. Be a student of history and realize that just because things worked out last time, people are constantly fighting the last war, and they're thinking that what happens next will be a lot like what happened last time, and there are always differences.
Oh, yeah. Yeah, and I think, you learn from your experiences, you learn from history, and I've had even without relatives of mine who just hoard cash because they're so worried about what's been ingrained with them from their parents, and they're so worried that they're not going to have the money. They're not, and so they don't even invest it, and they just hold it, and that's not helped them either.
No, exactly. Okay, let's go to number 5. We'll finish this off, and that's something called status quo bias. So status quo bias is where you like the way things are, and as a result, you don't want to change anything because you're afraid of change. So you've all heard the phrase, if it ain't broke, don't fix it. Well, a lot of people will say it ain't broke, even if it is pretty obviously not working the way it ought to.
Yeah.
Not because they don't recognize it, but because they don't want to fix it, because they're comfortable. People don't want to learn new skills. People don't want to learn new approaches. And as a result, they will continue to do things that are not necessarily great, but it's all they know. And I'll give you a personal example. My dad, I grew up on a farm in southwestern Ontario. And my dad, who was a great farmer in terms of growing crops, but farming, by the time he got out of the business at the turn of the millennium, was not a particularly profitable business. It was a small family farm. It had high overhead. And my mom would show him the tax returns and she'd say, Neil, you didn't make any money this year. You worked really, really hard. But my dad loved farming. So the evidence said you should actually get out. You're not actually even making any money. This is actually, if anything, it might even be costing you money for your quality of life and for all other reasons. The best thing that you can do is to stop farming, sell the farm, pocket the money, and stop bleeding. That's easy to understand intellectually. But if you love farming and it's your identity and it's all you've done in your entire adult life, it's hard to do. So people have to learn to not resist change and to embrace it. And when the evidence says that actually the world has changed, you need to recognize that the world has changed and move on.
So you're talking resist change. Is that the same thing as like, they hear the golden handcuffs syndrome where like people have like a very good job and so they can't actually, change or actually from in my situation, like I have people who they never take action because they have such a good job that they're not pushed to actually do the things they need to do in order to advance themselves. Is that the same thing or is that a different one of those?
Can be. It's not necessarily, but
Okay.
certainly if you're I guess the question is the opportunity cost. If you're resisting change because what you have is good enough, then you will resist change because you might do better, but you also might do worse. And you satisfice. The term in behavioral finance is called satisficing, where the first decision that you can come to that's good enough is the one that you settle on because it's good enough. If you're looking for buying a car, you've got a Camry and you've got an Accord, and they're both similar and you take a test drive in one, you say, yeah, it's the price that I was willing to pay. I like it, blah, blah, blah. You don't even bother test driving the other one because it's good enough and you just move on. So that's what I'm talking about is that if you're able to simply make a decision based on the information you have and it's good enough, it may not be a bad decision, but there may be a better decision that's out there that you'll never know was out there because you didn't explore any further.
Ah, yeah. I don't even know what to say. That was great. That was great. But no, I'm. Yeah, there's so many things that hold these people back. um, yeah, and then you have the opposite. Whoops, sorry, I just hit my book. But I have the opposite too. Like what you were talking about at the start is the people that have all the holdbacks that hold them back from making the investment to advance themselves, and then you have the other people who just ignore all the signs and just go for it, and they have the opposite risk.
Right. And that could be the overconfidence and that can work out. I'm not suggesting overconfidence as an example is necessarily bad. It's just something that you should be aware of and you should have in the back of your mind. Am I overconfident? A lot of people would never be wildly successful if they weren't overconfident. So it's not necessarily a bad thing.
No, I agree. Because otherwise, for myself, I never would have started the business that I started without it. Because when I started, I didn't know all the answers. I didn't understand a lot of stuff that needed to be done. I didn't understand all the, tax issues with different countries. And, but I knew I could figure it out. And that's the hardest way to do it, honestly, to figure it out yourself. But I don't know. I think if I didn't have the confidence to just go and do it, I wouldn't be where I am, right? I'd still be working a job. So anyway, no, I think that there's got to be a happy median between all of these things, from the not taking action to the overtaking action without the kind of not taking or carelessly taking action, I guess is the way to think of it.
So I agree. I think my summary would be if there's anything that we've learned, especially in financial economics and in personal finance in the past 20 or 25 years, is that human emotion and human decision making plays a much bigger role than traditional economics textbooks and courses would have us believe. And if you're just an ordinary investor who's got a day job because you're a nurse or a construction worker or whatever else that you do, you're probably not going to ever bother taking an economics course or a finance course anyway. So it behooves you as an ordinary retail investor to, at the very least, be mindful of your own biases before you make any decisions, because those decisions and biases can be consequential.
I wonder how, if there's like a test or some way to figure out which kind of what your weakness is. Because I got a lot of it is self-awareness. And if you know what your weakness is or where you, what the way you think, then you can make a change, or you can put somebody in your corner that has the opposite strengths as yourself. Do you know of any tests or any way of analyzing
I don't
this?
know of any tests. I suppose you could go online. I do know of some people that have various things where you could help advisors peel back the layers of the onion to ask questions of their clients to understand personal history, personal predispositions, attitudinal things. But those are of some value. But I think when the time comes to actually make decisions, understanding your history, your upbringing, your socialization, your friends helps. But I don't know that there's a definitive way to, because everyone is case by case. So I think what you might want to do is find a book on behavioral economics and read it. And what it will do is it'll get the wheels turning, thinking about, oh, I need to think about how I think. I need to think about how I make my decisions. And you will say, oh, what do you mean? I make decisions because I'm rational. I think of all the information and I look at what's best, and then I decide. Yeah, that's what we all tell ourselves. But in reality, there are a lot of things that we do that we have blind spots. And if you don't try to unearth your blind spots, you'll never resolve the problems that those blind spots exacerbate.
Yeah, and I know that like some financial planners, they make you do like sort of a questionnaire when you're being onboarded, which you're like trying to gauge what your risk level is and
Yes.
different things. So even doing that and even being self-aware while you're doing it, like why are you saying this? What's influencing your decisions?
So what I will say there, Glenn, is that there's actually a lot of research that the very large majority of those questionnaires are not academically robust.
Okay.
And as a result, they're being used for the industry, the firms that these advisors work for, to say so they can plausibly say we've done some work on the onboarding to assess the client's risk profile. But if the questionnaires are not large enough, the sample size is too large because you don't ask enough questions, you don't cross-examine, ask the same question a different way to make sure the answers are the same and consistent, then what you're getting is gobbledygook, and it's more or less useless. But the only real utility it has is that it allows the firms and the advisors that work for the firms to say, well, don't look at me, I asked. But you're asking questions that you know are not going to be giving reliable answers. You're just going through the process to cover your tail to say, well, I asked. You're not actually trying to help people discover what their real risk profile is, both in terms of tolerance and capacity.
Makes a lot of sense, because like some of them would just be like, the question would be like, what's your risk tolerance? 1 to 5. You're like, I don't know. 5? 1?
And here's an example, Glenn, with regard to recency bias. If the market has been going up, people will say, oh, I'm a 5, I can handle it. And if the market has been going down, oh, I'm a 2, I can't handle it. Well, wait a minute. Whatever you are is what you should be, and whatever the market did last quarter or last year should not have impact what you are. But recency bias plays a role. You will make your decision about what your worldview is going forward based on what you've experienced in the recent past, and that shouldn't be.
Yeah. Yeah. No, I totally agree. And I actually, I experienced the same thing just talking to people. John, people listening to this, they're like, hey, I like what you're putting down. How do they find your book? How do they find you? Where are you? Oh, where are you online? How do they find you?
So the way you can reach me directly, probably the easiest way is to go to my website, which is johndegoey.ca. So John, my last name is spelled DEGOEY.ca. That's my website. I've got a podcast called Make Better Wealth Decisions. It's available on all platforms, on YouTube, on Spotify, on Apple iTunes, you name it. And if you go to Amazon, you can get a copy of my most recent book called Bullshift, how optimism bias threatens your finances. And I talk about optimism bias as the main problem, but a lot of the things that we talked about in the call today, Glenn, are things that I talk about in the book as well, because there are optimism bias is just one of dozens of biases that we're all prone to. And I'm trying to help people navigate the whole swath of financial decision making, not just optimism bias.
Awesome. And people hearing this, where do they buy the book? Do they buy it on your website? Do they buy it on Amazon? Where do they get it?
No, not on Amazon. Not on my website. So you can go to Amazon. You can go to any bookstore. It's available in bookstores across the country. So if you go to Indigo or whatever chapters, you can get it there as well. And if they're sold out, just go in order. They'll get it for you soon enough.
And then, is there an audio version? I know some people listen or might be thinking.
You know what? I didn't record it, and I think the answer is yes. I published through Dundurn Press, and Dundurn did tell me they were going to do an audio version. I confess that I've never listened to my own audiobook. So, but apparently the answer is yes.
Awesome. Okay. Is there anything else I should have asked you?
No, I think that's fine. I'm delighted, Glenn. Thank you very much for having me. I really enjoyed this.
Yeah, no, this was great, and I think I think a lot of people can sit back. At least even myself, what I'll do with this is I like to listen to it and re-listen to when I have podcasts like this, and try to figure out where I fit in each of these things, so that I can, just be self-aware, figure out where my issues are, and then honestly, that's all how I build my team out. I'm like, okay, I hate doing this, or maybe it's I'm not good at this, and that's where you find someone to match or counter match your abilities. So yeah, if you're listening to this, reach out to John, see what we can help you with.
Thanks so much.
Thanks, John.
That was a nice video. Bye.